All right, we're live. We have a few important messages for you today. You're watching Be the Boss of Your Money. I'm Mitch Goldberg, and if you want to learn more about me, or if you want to take this conversation to a one-on-one basis, we'll talk about your investing. How are you invested? What should you be investing in? What should your plans be? Are you doing everything you possibly could to potentially get the most out of your money, out of your investments? Are you ready for retirement? Are you doing the right things now to get ready for retirement? This is what I do as a financial advisor with over 30 years experience. So if you'd like to reach out to me, check me out at Client First Strategy or send me a DM. And we're going to go on with a couple of important messages. First of all, the unexpected is something that you should expect. We've talked about this before. You really need to get ready for the major averages to make new highs, not for the major averages to crack. And when the averages were going down from the middle of July through August, September, and October, a lot of people, I was really surprised at how negative, how downright pessimistic investors got. I mean, we're going into a recession or inflation is going to skyrocket. And when the 10-year yield and the 10-year treasury yield, when that hit 5%, people got so overwhelmingly negative. It's now it's going to go to 6 or 7%. Our contention here has always been, if you watch the show, that 5% is a good deal. That's a great deal for investors. And we talked about this. If 5%, if we talked about this, that if 5% meets your bogey for what you need to make as an interest rate on the fixed income component of your portfolio, the 10-year zero coupon treasury was the overwhelming favorite, a great way to go. So we talked about that, a couple other things. You know what? I just remembered we have to run the intro. So let's run the intro, and we're going to talk about how to get ready to take money out of your IRA, because we always talk about invest, dollar cost average, et cetera, for years and years and years. Get ready for your retirement. But taking money out of your retirement plan, flipping the switch from accumulating to withdrawing, is a very scary thing, a very emotional thing for people. We'll talk a little bit about that. I think that's the most important thing we're going to talk about. So here we go. First, another sip of coffee. Good stuff. What we're talking about first is the market. We'll just take a quick look at how things went. I've got a couple of points to make. I think they're mostly bullish. All right. So you could see the Dow is up another 158 points. That's another record, obviously, for record territory. The major averages keep going up. We keep hitting records. So the Dow continues to go deeper into further all-time highs. Nobody expected to see the Dow at an all-time high. Do you know that about 3 months ago, actually, it was about 2 months ago, the Dow was negative on the year? It was negative on the year, all right? And you know that the S&P 500 is now a mere 1.5% away from hitting an all-time new record closing high. NASDAQ is about 8-9% away. And gold is holding above 2,000, especially after today it went above 2,000. Oil was up a bit, 71.65. And why did oil go up? Because if you believe a recession in the United States is going to be avoided, it's probably bullish for gold. Economic activity will be better than a lot of people thought. So people thinking they better own oil. Doesn't mean we go into boom times in the economy. It just means that, if oil should not be reflecting a recession based on the price of oil. The 10-year yield, and this is the biggest story of the day. Really, we talk about the stock market, we talk about stocks, we talk about the major averages. The 10-year yield, we talked about this when it was 5%. I said, I think you're going to see this back down with a 3 handle in the not too distant future. So while you're collecting 5% on CDs, savings accounts, money market accounts, that's great. But go further out on the bond timing, maybe buy 5, 7, 10 years out, lock in some of that beautiful, delicious, lovely, wonderful 5% yield for the long term. And people would say, why do I want to go out 10 years on a 10-year bond when I could buy a money market for 5% today and have liquidity? I don't have to wait 10 years. I really don't know why people ask you, but I'll tell you why. If you're new to this, I want you to know, and it's not me being mean or arrogant to you, but if you watch the show, and you can explain this to those who don't know. The short-term yields you're getting will, in my opinion, come down a lot. If you think the Fed cuts 3 times next year and 4 times the following year, you're going to see yields on treasuries, short-term treasuries, and you're going to see savings accounts and money market rates. Those are going to go down too. So in the meantime, those will be down to 2 or 3 or 4%, probably lower than 4% eventually. And then you'll be like, there's no place to put my money. But you could have been making 5% this whole time in longer dated assets. And that's why you should diversify your time horizon, not just short-term CDs, money markets, other cash equivalents, but maybe 3, 5, 7, 10 years out. All right, diversification. It's a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. And you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. So the VIX is still at 12. Look at that, 12. I mean, people are thinking, oh, the VIX is going to 30, the market's going to tank. It's at 12 now. And we spoke about this. I have every reason to believe that this should continue. Every reason to believe that. Let's take a look at the yields. Another big story today. Look at this. The 1-year yield went below 5%. Can you believe it? You're not, so all that whole time we're talking about getting 5% in a 1-year T-bill. Well, why would I buy that when I could get 5% in a savings account, a high yield savings account? Well, by the time the high yield savings account's down to about 3%, and you're going to be like, I don't have any good place to put my money, longer dated securities are already down. So you're running out of options if you want to invest for the longer term, unless you want to go into like corporate bonds and especially junk bonds. And maybe that's for you. I find most people don't realize that every certain amount of time, every couple of years, there's a crash in the junk bonds. They do very poorly. And then you scratch your head wondering, why was I chasing yield? Because the harder you chase yield, the harder you're going to get hit when stuff falls apart. That stuff always falls apart. Oh, we checked out our bonds. We're buying really good companies. They're misunderstood or mispriced. I don't care what the research is that some fund manager's doing. They ultimately blow up. And, whatever back testing they did based on whatever metrics they used, in reality, they don't always come true. In fact, they don't come true. And then you wind up with losses, cut, a lower dividend. And you're wondering, what am I doing with these assets? And eventually you'll just sell them at a loss finally and move into something else. But it's going to take you years to do that because that's how long people wait to sell something that's not working. People wait years. And they hope to break even. The number one reason people sell a security is to break even, right? True. Oh, so the 10-year at 3.9%. But I want to show you something. This is bullish. That's helping drive the market, okay? Tesla was as high as $299. It's $250. See that red over there? And NVIDIA was $505. It's $483. I'm glad it's up yesterday and today because it seems like it's going down every day. Apple hanging near its high. Meta, not far from its high, but not one of the stocks leading the charge. Google, not leading the charge. Amazon is close, but not leading the charge. Netflix, not leading the charge. Microsoft is not leading the charge. What's leading the charge? I'll show you. United Rentals up 39. Caterpillar up 17. So up 7.5%, up 6.4% in Caterpillar. Wabash National up 5.7%. They make trailers for tractor trailers. UAL up almost 5%. Okay. American Airlines up 3.5%. UPS up over 3%. 3M even. Boeing up another $5. It's another year high for Boeing. Okay. That's what's leading the charge. You want more of what's leading the charge? Hold on, I'm stuck. All right. All right. Let me just fix this. Forget this. I need to take this out. This penny stock. First Republic. First Republic. Oh, First Republic. We're so helpful. They blew up. Zion Bank up 9%. US Bancorp, which you spoke about that stock like what, 4 or 5 weeks ago at 32, 33. It's 45 now. Morgan Stanley up 6%. Bank of America up 6%. KeyBank up 6%. Wells Fargo, in spite of like another scandal that they give white people better deals on mortgages than black people. That's what they've been doing. They got caught. You know, whenever there's a scandal, somehow the name Wells Fargo comes up every time. You ever notice that? Goldman Sachs up 5%. That's huge, up almost 6%. Okay. It's a Dow component. IAT, this is from iShares Regional Bank ETF, up 5.5%. That's what's leading the charge. These here, okay, Visa's not a bank, MasterCard's not a bank, Travelers is insurance, AIG insurance, and Berkshire Hathaway. Berkshire Hathaway's been hitting your highs regardless, but that's a whole different story. But bank stocks have been going up. That's what's leading the charge. Let's check the comments. Hey, Lindy Prue. That's Linda Goodman Levine. Thank you so much for joining me. I see you later. That's my girlfriend, by the way. And thank you. So we are doing so good today. You're saying OMG because I actually said you're my girlfriend on the live stream and people are going to say it. Okay. Or are you doing that because I just went, and that's kind of like, not something you'd expect. And everybody watching, say hello. Give us a thumbs up, ask us questions. All right. So the charge is being the rally is broadening out. I really don't think I can overstate how powerful this is. But I want to show you my face, my facial expression when the Dow goes down or the S&P goes down 20%. Take a screenshot. Now I want to show you my expression when the Dow or the S&P 500 hits a new high. Take another screenshot. All right, you ready? Yeah, it's the same face. I don't get phased either way. I'm not like in a better bouncy mood because the averages are up a lot. And I'm not in like a downright depressed mood because the averages touched a low. It's just part of the process. I knew this was going to happen. No. No. I'm not trying to say that I see the future. I know something you don't. I know something that you already know. I knew the market was going to go down. I knew the market was going to go up because that's what it does. It's a cycle of ups and downs. And over time, we get higher lows and higher highs. And gradually we make progress. Over time, we expect the economy to expand and contract. That's recessionary economic recession, economic expansion. And as a result, the stock market grows and contracts and grows and contracts. And every time we've hit a low, a bear market, we've recovered and we've made a new high. So I knew this was going to happen. If I can only tell you what day everything is going to happen, that would be a different story. But I don't sit here and worry about that because I don't have control over it. I have control over my ability to be patient. I have control over my ability to invest according to my risk tolerance, my needs, my goals, my financial obligations. And when I do that, it makes me steady. I don't worry about all the external factors because I've got all my ducks in a row. And that's really what it comes down to, having your ducks in a row. Let's talk about taking money out of your retirement plans a little bit more. It's a scary thing. You are taught to accumulate assets, dollar cost average, invest in a 401k plan. It goes on and on and on. Never take money out of your plan. Never borrow except for a mortgage or for your business if you're starting a new business. But other than that, you need to accumulate assets. And then you get to a point in life where it's time to flip the switch and do the opposite. Instead of dollar cost averaging in, you dollar cost average out. And there are some guardrails you could put on that. There's strategies that you could use. One of those is the 4% rule, where you take out 4% of the year-end value of your portfolio every year. It's been studied up and down that if you do that, you could make your portfolio last for the rest of your life, 30 years plus. Sometimes you need to take out more. Sometimes you need to take out less, and the 4% rule is not enough for you. You can make it the 5% rule, or you can make it a fixed dollar amount. Just know that the more you take, the sooner your portfolio runs down to zero. And that could be in 30 years. It could be in 20 years. Just know that. There's no way to know which are the best years to take money out in advance, which years are the worst to take money out. But we don't worry about that. Your portfolio takes into account ups and downs of the market, of the economy. And as a result, you stay consistent with what you take in and with what you take out. You stay consistent with what you take out, regardless of the vagaries of the ups and downs of the economy and the stock market. This way you take control. You make your money last longer. Certainly, 4% after the market goes up 20% is a lot more than 4% of your portfolio after the market goes down 20%, for example. But when you stick to the guardrails and limit how much you could take out, you wind up with a picture of how much longer your money could last. It's the consistency that will help you make your money last. It's staying invested in the stock market, not saying, well, let me get out, and then when times get better, I'll invest everything back in, and my account will grow so much that I'll have years and years of extra money and I could live a lot better. I have yet to see that happen in 30 some odd years. When things are better, it means the stock market is already back up and you've missed the gains. How many people got out of the market 3 months ago, 2 months ago, a month and a half ago, and have missed one of the best year-end rallies that I have ever seen in my 34-year career? Can you imagine missing out on this rally? This is why I say stick with quality, stick with it, stick. Check me out at Client First Strategy. My phone number is there. My email address is there. Reach out to me if you want to talk about your portfolio, hidden gems that you could find in your financial plan, your finances, maybe a Roth conversion, maybe something you could do to help lower your taxes. We want to talk about these things. I know I'm not an accountant or tax advisor, so you should always consult with your tax advisor when we talk about taxes. But in the scope of things that I do, maybe tax loss harvesting would be a good thing for you to do right now. Maybe you're better off in municipal bonds in your taxable account than regular corporate or treasuries. These are the things that we look for to help you make the most of your money. Remember, sometimes it's not a matter of making more money, especially when you retire, because you can't make more money, not with an active income, but sometimes it's more a matter of keeping more of what you've already accumulated, because a dollar saved is a dollar earned. Thank you so much for watching, and I'll see you next Monday, unless something crazy happens in the market tomorrow. Have a great weekend, everybody.